There is a real possibility that HMRC has been taking too much tax from your pension, not through fraud, not through some complicated loophole, but through a technical problem that has quietly affected the finances of millions of retired people across the United Kingdom, in some cases for years. If you have recently started drawing from a private pension or a workplace scheme, or if you have had any change in your pension income, this is something you genuinely need to hear about. The money involved is not trivial. We are talking about hundreds and in some situations thousands of pounds that pensioners have overpaid, often without ever realizing it. So before you assume your tax bill is simply what it is, stay with us, because what we are about to explain could put real money back in your pocket. Welcome to Prime DWP UK Guide, the channel dedicated to helping people across the United Kingdom understand their rights, their entitlements, and the financial information that actually matters in retirement. Whether you are already drawing your pension or still planning for it, our job is to cut through the noise and give you the clear, honest guidance you deserve. And today, the topic we need to cover is one that has quietly frustrated pensioners for years, yet rarely gets the plain English explanation it warrants. To understand what has gone wrong, you need to know a little about something called emergency tax. When you access a pension for the first time, particularly a personal pension or a workplace scheme, HMRC does not always know exactly how much income you will be receiving across the full year. In the absence of a proper tax code, they instruct the pension provider to apply what is known as a month one emergency tax code. The problem with this approach is that it calculates your tax as though that single payment is the only income you will ever receive, then multiplies it across 12 months to arrive at a supposed annual figure. If you take out a lump sum of £10,000, for instance, the system may treat that as if you earn £120,000 a year and tax you accordingly. The deduction that gets taken out of your pension payment can therefore be drastically higher than what you actually owe. This is not a new problem. HMRC and pension providers have known about it for years, but what has brought it back into sharp focus recently is the sheer scale of the figures involved. Since the pension freedoms legislation came into force in 2015, which allowed people over 55 to access their pension pots far more flexibly than before, the number of people drawing down from defined contribution schemes has risen substantially. And with that increase has come a corresponding rise in emergency tax incidents. According to data published by HMRC itself, pension savers have collectively reclaimed over £1 billion in overpaid tax since those freedoms were introduced. £1 billion. That figure alone tells you that this is not an occasional clerical error affecting a handful of people. It is a structural problem embedded in the system. Consider someone like Margaret, a retired nurse from Coventry in her early 60s, who decided to take a portion of her private pension to help with some home repairs. She had saved carefully over her working life and felt confident she understood roughly what she would receive after tax. But when the payment arrived, it was significantly lower than expected. After some investigation, she discovered that the pension provider had applied an emergency tax code and deducted tax at a far higher rate than her actual circumstances warranted. She was eventually refunded, but it took months, several phone calls, and a formal claim process she had never heard of before. Margaret is not unusual. Her experience is one that tens of thousands of pensioners have gone through, and many more are still going through right now without realizing there is anything they can do about it. The practical question then is what you should do if you think this has happened to you. HMRC provides 3 specific claim forms depending on your situation. If you have taken all of the money out of a defined contribution pension pot and have no other income, you use the P50Z form. If you have taken a flexible payment from your pension, but you are not working and have no other income, the form you need is the P53Z. And if you have taken a flexible payment, but you do still have other income, such as employment income or other pension payments, then the correct form is the P55. These forms allow you to reclaim the overpaid tax without waiting for the end of the tax year, which is important because HMRC does not automatically refund emergency tax in real time. If you do nothing, the tax system may eventually correct itself through your annual tax code, but that process can take many months. And in the meantime, your money is sitting with HMRC rather than in your account. It is also worth knowing that you do not necessarily need to wait until after you have received a pension payment to address the tax code issue. If you are planning to draw from a pension and you want to avoid the emergency tax situation arising in the first place, you can contact HMRC before the payment is made and request that a proper cumulative tax code is applied. Whether that always works smoothly in practice is another matter, but being proactive does give you a better chance of avoiding the problem entirely. There is a broader point here that goes beyond the technical mechanics of tax codes. For many pensioners, particularly those who are not comfortable navigating government websites or deciphering HMRC correspondence, this kind of overpayment can cause genuine financial stress. When you are living on a fixed retirement income, having a substantial chunk of your pension payment taken in error is not an abstract inconvenience. It affects whether you can pay your bills on time, whether you can help your family, whether you feel financially secure in the life you worked decades to build. The people most affected by this problem are often those least equipped to chase HMRC for a refund, and that is a situation that deserves far more public attention than it typically gets. Pension credit recipients and those close to the pension credit threshold need to be particularly careful here as well. An apparent spike in income caused by a large pension withdrawal, even one that has been partially clawed back by emergency tax, can affect means-tested benefit calculations if not properly documented. It is always worth informing the relevant offices of the circumstances if you have taken a pension lump sum and are also claiming or applying for income-related support. It is also worth being aware that financial advisors and pension providers have a responsibility to explain these risks to you before you access your pension. The FCA and government guidance both indicate that consumers should be made aware of the emergency tax issue before drawing down. If you were not given that information, that is something you may want to raise with your provider. While you cannot claim compensation simply for not being warned, putting your concern in writing creates a record and may speed up any refund process. The government has faced criticism from pension industry bodies and consumer groups for not updating the emergency tax system to something more accurate. Critics argue that in an era when pension access is more flexible than ever, defaulting to an emergency code that consistently overtaxes people at the point of withdrawal is simply not fit for purpose. The counter-argument from HMRC is that the system eventually self-corrects and that refund mechanisms exist for this exact reason. Whether that answer satisfies someone who has waited 6 months for their own money to be returned is perhaps a matter of perspective. What is clear is that this is not going away. Pension withdrawals will continue to increase as the population ages and as more people reach the age where accessing flexible pension savings becomes relevant. That means more emergency tax incidents, more reclaim forms, and more people needing to navigate a process that most were never told about when they first started saving for retirement. If you think you may have been overtaxed on a pension payment, do not wait. Check your pension statement, compare the tax deducted against what you would expect to pay based on your actual annual income, and if there is a significant discrepancy, look up the appropriate HMRC reclaim form and submit it. You can also call HMRC directly on 03-002-003-300. Though wait times vary and having your national insurance number and pension details ready before you call will save you time. The system should make this easier than it does, but until it does, knowing how it works is the next best thing. If today's information was useful to you, the best thing you can do is subscribe to Prime DWP UK Guide so you do not miss future videos on pension rights, DWP benefit changes, and the kind of practical financial information that genuinely matters when you are planning for or living in retirement. We cover these topics regularly and always in plain language because you should not need a tax accountant to understand what is happening with your own money. Share this video with anyone you know who has recently accessed a pension. It could save them a significant amount of money and a great deal of unnecessary stress.